Top three things in my notebook this morning. Number one, my buddy, Ben Bernanke. Number two, the 10-year bond yield. And number three, the price of oil. So my pal was with the boys at Morgan Stanley yesterday, and the gals, and started talking about his GDP forecast. Now, as most of you know, Ben Bernanke's GDP forecasts have been wrong about 71% of the time, so he is highly convicted in this view that consensus isn't bullish enough on Q3, Q4, and 2014 GDP growth. I mean, imagine that. And he's also talking up interest rates. So again, I don't think that he crossed the lines and dotted the T's and the I's and everything else with Janet on this. Now, Janet may have a little discussion with Ben. But that moved the bond market big time. Again, a little bit of a crony action there. Again, big transparency, accountability Fed brought to you by Gillette. 10-year bond yield, looking at that in terms of levels, looking at the downside today to 233, upside to 258. Now, 258 on the 10-year bond yield is precisely the level that we banged up against in August. We've been banging up against lower highs in the 10-year bond yield throughout the year. And yes, people like Ben Bernanke have been hoping for growth throughout the year. Now, hope is not a risk management process. So again, just look at the risk range. What's happening now is that the risk range in the 10-year bond yield is widening. A widening range is basically a leading indicator for volatility. So yes, I think, Mr. Bernanke, you just imposed one heck of a lot of volatility in the bond market into the Fed meeting. And yes, we continue to think that bond yields go lower, not higher, in 2014. Then finally, looking at the price of oil, all of this, of course, is interconnected. So this is why it's so critical to follow what the central planners are eating and whispering. But again, you look at it for what it is, because now both gold and oil in particular have picked up huge immediate term correlations to the US dollar and interest rates going up. Now, that makes sense. Dollar up, rates up equals gold down. But again, if the Fed doesn't deliver on this, which we don't think it will, we think the Fed goes into data dependence, and as the data slows, they will get more dovish. So in the face of that, dollar down would mean oil up, gold up, and S&P down. So again, think about those correlations, because they're not happening yet, and people are very uncomfortable with making the other call of what's not happening, but that's what we do at Hedgeye Risk Management. So those are your top three things.